Every successful business is built on accurate financial records, and that starts with good bookkeeping. Unfortunately, many business owners see bookkeeping as a difficult task, which leads to missed transactions, inaccurate reports, cash flow problems, and costly financial mistakes. In this video, you will learn business bookkeeping through simple, practical, real-world examples. Setting up your business books correctly. A strong bookkeeping system starts long before the first transaction is recorded. It begins with setting everything up correctly from the start. First, open a dedicated business bank account and keep personal spending completely separate from business spending. Mixing the two creates confusion and makes it difficult to understand your true financial position. Next, choose a bookkeeping method that matches the size of your business. Most small businesses use double-entry bookkeeping because every transaction affects at least two accounts, creating more accurate financial records. After that, decide whether you'll use bookkeeping software or maintain organized spreadsheets. Whatever method you choose, consistency matters far more than complexity. Create categories for your income: operating expenses, payroll, rent, utilities, marketing, equipment, taxes, and other common business activities. These categories will help organize every future transaction. Also, establish a routine for saving receipts, invoices, and supporting documents. Digital copies are usually easier to store and search than paper files. Finally, decide how often you will update your books. Waiting until the end of the year usually leads to missing transactions and unnecessary stress. Weekly bookkeeping sessions often work well because the workload stays manageable. Understanding the chart of accounts. The chart of accounts is the foundation of every bookkeeping system. It is simply a complete list of financial categories where every transaction is recorded. Instead of placing every dollar into one large bucket, bookkeeping separates financial activity into organized groups, so you always know where money comes from and where it goes. Most charts of accounts include 5 main categories. Assets represent everything the business owns, such as cash, inventory, equipment, and accounts receivable. Liabilities include obligations like business loans, unpaid supplier invoices, and taxes owed. Equity represents the owner's investment and retained earnings. Revenue records money earned from selling products or services. Expenses include all the costs required to operate the business, such as advertising, insurance, payroll, office supplies, rent, utilities, and software subscriptions. Imagine buying a new laptop for the office. That purchase should not be mixed with utility bills or advertising costs, because each expense tells a different story about how your business operates. A well-designed chart of accounts makes financial reports much easier to understand because similar transactions stay grouped together. As your business grows, you can always add new categories when necessary, but avoid creating too many accounts. Recording daily business transactions. Every business transaction should be recorded as soon as it happens. Waiting until the end of the week or month increases the chances of forgetting important details, losing receipts, or making inaccurate entries. Every sale, customer payment, supplier invoice, refund, business purchase, bank fee, and loan payment should become part of your bookkeeping records. The key is consistency, not speed. A business that records transactions every day usually has far more accurate financial reports than one that updates its books only when tax season arrives. Always record the transaction date, the amount, the payment method, and the correct account category. Supporting documents such as invoices, receipts, purchase orders, and payment confirmations should also be stored because they verify every entry. Avoid estimating numbers or relying on memory. If something is unclear, verify it before recording it. Small mistakes repeated every day eventually create large financial problems. Develop a simple daily routine that takes only a few minutes. Review sales, match incoming payments, record expenses, and organize documents before ending the business day. This habit prevents backlogs and keeps financial information current. When your books are updated daily, you always know how much money the business earned, what expenses were paid, and whether your cash position is improving or weakening. Managing sales, invoices, and customer payments. Sales generate revenue, but revenue alone does not improve cash flow unless customers actually pay. That is why bookkeeping must track not only sales, but also invoices and collections. Every completed sale should be recorded immediately, whether payment is received instantly or expected later. If you provide products or services on credit, create an invoice that clearly shows the amount due, payment terms, invoice date, and due date. Once the invoice is issued, record it as money owed to your business. As customer payments arrive, match each payment to the correct invoice instead of simply recording it as new income. This process helps you identify which customers have paid and which still owe money. Regularly reviewing unpaid invoices also helps reduce overdue accounts before they become serious cash flow problems. If customers receive discounts, refunds, or credit notes, record those adjustments accurately so your financial reports remain correct. Never leave outstanding invoices unreviewed for months because delayed collections often become unpaid debts. A simple weekly review of accounts receivable allows you to follow up with customers before payments become severely overdue. Good bookkeeping transforms sales information into useful business insights. Tracking business expenses and bills. Every successful business controls expenses just as carefully as it tracks sales. Bookkeeping provides that control by recording every cost accurately and consistently. Every expense should be supported by a receipt, invoice, contract, or payment confirmation. Whether you purchase office supplies, pay rent, buy inventory, purchase software, or pay utility bills, each expense belongs in the correct category. Accurate categorization helps you understand where your money is being spent and makes future budgeting much easier. Businesses often lose profits not because sales decline, but because unnecessary expenses slowly increase without anyone noticing. Regular bookkeeping helps identify these trends early. Bills that remain unpaid should also be recorded as liabilities until payment is made. This prevents forgotten obligations and gives you a complete picture of upcoming cash requirements. Establish a routine for reviewing recurring expenses such as subscriptions, insurance, internet services, equipment leases, and maintenance contracts. Some costs may no longer provide value and can be reduced or eliminated. Bookkeeping also helps separate one-time purchases from ongoing operating expenses, making financial reports easier to interpret. At the end of each month, compare total expenses against revenue to understand whether spending remains within healthy limits. Bank reconciliation without mistakes. Bank reconciliation is the process of comparing your bookkeeping records with your bank statement to make sure every transaction matches correctly. While it may seem like an extra task, it is one of the most important habits in bookkeeping because it helps catch mistakes before they become expensive problems. Sometimes a payment is recorded twice, a bank fee is forgotten, a customer payment is missing, or an incorrect amount is entered into the books. Without reconciliation, these small errors can remain hidden for months. Start by reviewing the opening bank balance, then compare every deposit, withdrawal, transfer, and bank charge with your bookkeeping records. If something appears on the bank statement but not in your books, investigate the difference immediately. Likewise, if a transaction exists in your records but not on the bank statement, determine whether it is still pending or was entered incorrectly. Never ignore differences simply because they seem small. Even minor discrepancies can create inaccurate financial reports over time. Most businesses benefit from reconciling their accounts every month, while businesses with high transaction volumes may choose to do it weekly. Once reconciliation becomes a routine, your financial records become far more reliable. Managing inventory through bookkeeping. Inventory is often one of the largest investments a business makes, which is why it must be tracked carefully through bookkeeping. Every product purchased, sold, returned, damaged, or discarded should be recorded accurately. Without proper inventory records, it becomes difficult to know how much stock is available, how much money is tied up in products, and whether inventory is generating profits or simply sitting on shelves. When new inventory is purchased, record both the quantity and the total cost. As products are sold, update inventory records so your remaining stock stays accurate. Regular physical inventory counts should also be performed because actual stock may differ from recorded amounts due to errors, theft, damage, or misplaced items. Comparing physical inventory with bookkeeping records helps identify these issues before they grow into larger financial losses. Good inventory bookkeeping also improves purchasing decisions. Instead of ordering products based on guesswork, you can see which items sell quickly, which move slowly, and which rarely sell at all. Slow-moving inventory ties up cash that could be invested elsewhere in the business. Accurate inventory records also improve profit calculations because the cost of product sold is recorded correctly. Payroll and employee record keeping. Employees are one of the most valuable assets in any business, but payroll is also one of the most sensitive areas of bookkeeping. Every salary payment, hourly wage, bonus, commission, tax deduction, benefit, and reimbursement should be recorded accurately. Payroll mistakes not only create financial problems, but can also damage employee trust and lead to compliance issues. Begin by maintaining complete employee records, including employment agreements, salary details, tax information, working hours, leave records, and payment history. Each payroll period should be calculated carefully to ensure every employee receives the correct amount. Once payroll is processed, record the total wages as a business expense while also recording any payroll-related liabilities until they are paid. Keep supporting documents such as payroll reports, payment confirmations, and tax filings organized for future reference. Business owners should also regularly review payroll expenses as a percentage of revenue to ensure labor costs remain sustainable as the business grows. Unexpected increases in overtime, bonuses, or staffing costs can reduce profitability if they are not monitored closely. Good bookkeeping provides complete visibility into payroll expenses, helping owners make informed hiring decisions while maintaining accurate financial records. Month-end bookkeeping checklist. The end of every month is the perfect time to review your bookkeeping and confirm that everything has been recorded accurately. A consistent month-end process prevents small errors from carrying into future months and gives you an accurate picture of your business performance. Start by ensuring all sales, expenses, invoices, and customer payments have been entered into your bookkeeping system. Next, reconcile every business bank account and verify that the balances match your records. Review outstanding customer invoices and identify which payments are overdue. Follow the same process for supplier bills to make sure upcoming obligations are clearly documented. Confirm that payroll entries, loan payments, subscriptions, and recurring expenses have all been recorded correctly. Review inventory if your business sells physical products, and investigate any unusual differences between actual stock and recorded quantities. Finally, generate your monthly financial reports and compare them with previous months. Look for unexpected increases in expenses, declining sales, shrinking profit margins, or cash flow concerns. The goal is not simply to complete a checklist, but to understand what the numbers are telling you. A structured month-end review allows you to identify problems while they are still manageable, instead of discovering them months later. Reading profit and loss, balance sheet, and cash flow reports. Bookkeeping becomes truly valuable when it produces financial reports that help business owners make better decisions. The three most important reports are the profit and loss statement, the balance sheet, and the cash flow statement. The profit and loss statement shows how much revenue the business earned during a specific period, what expenses were incurred, and whether the business generated a profit or a loss. It answers one important question: is the business profitable? The balance sheet provides a snapshot of the company's financial position at a specific point in time. It shows what the business owns, what it owes, and the owner's equity. This report helps measure overall financial strength rather than monthly performance. The cash flow statement explains how money actually moved through the business. It tracks cash received from customers, cash spent on operations, investments, and financing activities. Many profitable businesses still experience financial stress because cash enters and leaves at different times. Reading all three reports together provides a complete understanding of business performance. Instead of focusing only on revenue or bank balances, business owners learn how profitability, financial position, and cash flow work together. If you found this video helpful, then like, share, and subscribe this channel to get future videos. Thank you for watching this video.